Silver is leading the metals market right now, and the people calling it just another hype spike are already late to the real story, because the headline price isn't even the loudest signal anymore. The structure underneath it is, and if you understand that structure, you'll know exactly what matters next week. What level flips this from rally into forced buying, and what would break the whole setup even if silver still looks strong on your screen. Here's the conflict. The tape looks like chaos, silver ripping through big round numbers, whipping a few dollars an hour, making everyone feel either invincible or stupid. But the market's plumbing is behaving like something is tight, something is stressed, and certain players are being pushed into decisions they can't delay. And that's where the real pressure starts. Let's anchor this in what just happened, not in vibes. Silver pushed through the $90 handle and printed above it, with a high around the low 92s on January 14th. 2026, then you saw a sharp pullback the next day with spot quoted around the high 80s, roughly $89 and change, while gold also cooled a bit after setting its own record. That whipsaw is exactly why most people misread silver. They look at the candle and they moralize it, but silver is a market where you can be directionally right and still get emotionally wrecked if you don't understand what volatility is doing to positioning, margin, and hedging. And the next detail is what flips the whole setup. When silver leads, it doesn't mean it's the safest metal in the room. It means it's the one with the most torque. It's the smaller pool that reacts harder when big money shifts, when industrial buyers refuse to pause, and when the derivatives layer starts feeding back into spot. Gold is the battleship. Silver is the speedboat with a rocket strapped to it. Same ocean, totally different handling. So the question isn't, why is silver up? Because everything can be up in a macro panic. The question is, why is silver acting like the front runner? And the answer is a stack of mechanisms that all point the same direction. Start with the macro backdrop, because it sets the stage for the investment bid. You've had a cocktail of geopolitical tension and policy credibility stress that pulls investors toward hard assets. In the last 48 hours alone, metals across the board hit extreme levels, gold at record highs, copper and tin ripping too, and the common thread wasn't a neat supply spreadsheet, it was fear and uncertainty. Fear of escalation in the Middle East, fear of tariff and stockpiling dynamics, and fear that central bank independence is becoming a political football. That kind of regime doesn't just lift gold, it lifts the whole complex. But silver is the one that turns that lift into a lunge. Because if this one level breaks, the math changes. The first hidden detail that reframes everything is that silver's rally is not just people buying silver. It's the market being forced to price time differently. In normal commodity markets, the future is more expensive than the present because carrying stuff costs money. Storage, insurance, financing. So you pay a premium for later delivery. That's contango. When you see the opposite, when the front end gets expensive relative to later months, when the curve flattens aggressively or inverts, that's the market saying, no, the real scarcity is now. Not someday, now. And in metals, when the market starts arguing about the value of time, you're not just watching speculation, you're watching stress in the availability of deliverable supply and the balance sheets that finance it. But that's not the part that matters most. The part that matters most is what that curve does to behavior. Because futures aren't just bets. They're obligations with collateral and delivery rules and risk teams behind them. When the front end tightens, shorts don't just lose money, they lose flexibility. When the curve shifts, the cost to roll changes. When implied volatility spikes, option dealers hedge differently. When margin requirements rise, leverage gets amputated. Those are mechanical forces, and they don't care what your opinion is. And right now, silver has multiple mechanical forces pushing in the same direction. Let's talk calendar, because timing is not a footnote here. It's the catalyst. You're in a period where liquidity thins and risk controls tighten. Month-end behavior, contract rolls, delivery windows, and options positioning all collide. When funds rebalance, when hedgers roll exposure, when dealers manage gamma around key strikes, you can get outsized moves on normal flows. Now add something silver-specific. The exchange itself has been increasing the cost of holding risk. CME has raised margin requirements multiple times recently, and they've also shifted to a margin framework that scales with notional value. So as price rises, the collateral burden rises too. That sounds like a technicality, but it's a weaponized accelerant for volatility. Here's why. Margin hikes don't predict a top, but they do force a decision. If you're leveraged long, you need more cash or you reduce. If you're short, you need more cash or you cover. If you're a market maker with inventory, you adjust quotes and you demand more compensation for risk. Everyone's risk department gets louder at the same time. And when silver is already moving fast, those forced decisions cluster. The market stops being a smooth auction and becomes a series of stampedes. This is why you'll see silver rip and then suddenly drop $2, $3, $4 in a blink. Not because the thesis changed, but because the collateral math changed. And that's where the real pressure starts. Now, here's the piece retail investors almost always miss. The inventory you hear about is not the inventory you can actually get. People say there's plenty of silver in vaults, and they wave around giant tonnage numbers, and they assume that means the market can't be tight. That's a rookie mistake. In metals, especially silver, availability is a category problem. There's metal that exists, there's metal that meets exchange specifications, and there's metal that is actually registered, warranted, deliverable, and economically rational to hand over at the current price. Those are not the same thing. On the comic side, you can literally see this in the warehouse stock reports. There's eligible metal, basically silver that meets the specs and sits in approved warehouses, and there's registered metal, the portion that has been tagged for delivery against futures. Eligible is potential. Registered is actionable. And as of the most recent report activity date in mid-January 2026, total registered silver was roughly 123 million ounces versus roughly 312 million ounces eligible, for a combined total around 434 million ounces. That ratio matters because it tells you how much of the pile is actually on the table for delivery without someone choosing to convert it. And conversion is a choice. Owners convert when the incentives are right, when the lease rate makes it worth it, when they're not using it as collateral elsewhere, and when they're not expecting a better deal later. In a rising, volatile market, owners often don't rush to make metal more available. They do the opposite. They wait. And that's not conspiracy. That's incentives. But that's not the only vault story. Look at London, the core of the OTC physical market. LBMA publishes monthly vault data, and as of end December 2025, London silver holdings were reported around 27,818 tons, up a bit from the prior month. Again, people will look at that and say, see, no problem. But totals don't tell you ownership. Totals don't tell you encumbrance. Totals don't tell you which bars are spoken for, pledged, leased, or sitting in the wrong place for the buyer who needs immediate delivery. The next detail is what flips the whole setup. When a market is tight, you don't always see inventories collapsing first. Sometimes you see frictions rising first. Higher lease rates, higher financing costs, longer lead times, higher premiums, more aggressive backwardation, weird roll behavior. That's the market whispering before it screams. And in silver, the whisper can be more important than the scream. So let's stack the proof like a professional, not like a hype thread. Proof point 1 is price action relative to the complex. Silver has been outperforming gold in percentage terms in the run-up, and it's doing it while other industrial metals are also elevated, which tells you this isn't a one-note, safe haven-only story. Proof point 2 is volatility behavior. Implied volatility in silver options has been elevated. CME's own volatility index for silver was showing readings in the 70s in early January. When implied vol lives there, hedging becomes expensive and dealer behavior becomes more reflexive, meaning moves can self-reinforce. Proof point 3 is the exchange tightening the screws. Repeated margin increases have made silver more expensive to trade, and yet price has still pushed higher, meaning the marginal buyer is either sufficiently motivated or sufficiently forced. Proof point 4 is physical market friction. Mainstream reports have noted strong Western demand for physical silver with long wait times at mints. When end product availability gets sticky at the consumer level, while futures are in a leverage-driven sprint, it's not proof of shortage, but it is proof of strain and demand intensity. Proof point 5 is the structural fundamental backdrop. The Silver Institute has been documenting multi-year deficits, with a reported global deficit around 148, 9 million ounces in 2024, and record industrial demand around 680. 5 million ounces that year, and a forecast deficit in 2025 that, while smaller, still implies demand outpacing supply. That's not a single-year fluke, that's a regime. And regimes don't end because a candle looks tall. But here's the underappreciated part, the hidden detail that makes silver different from gold right now. Silver has a dual bid, and those bids do not politely take turns. Gold has the luxury of being mostly monetary and sentiment-driven. Silver has to satisfy industrial procurement while also acting like a monetary metal during macro stress. That dual role creates moments where the investment crowd and the real economy crowd pull in the same direction. And when that happens, silver doesn't drift, it lunges. Solar is the cleanest example because it's not a boutique use case anymore. Silver demand tied to photovoltaic applications has grown into a meaningful chunk of industrial demand. And the Silver Institute has pointed out just how quickly that share has expanded over the last decade. Now add electrification, electronics, and increasingly AI-adjacent hardware that leans on high conductivity. Industrial demand isn't a Twitter poll. It's procurement. It's contracts. It's supply chain managers who don't get fired for paying up a little, but do get fired for missing deliveries. And procurement behavior is stubborn in a way speculative behavior isn't. But that's not the part that matters most. The part that matters most is that supply can't simply sprint to meet that demand even if prices scream. A huge portion of silver supply is byproduct, coming out of mines that are primarily focused on other metals like copper, lead, zinc, and gold. That means silver production responds to the economics of those primary metals, not cleanly to the silver price. If silver doubles, you don't get double the silver next quarter. You get higher recycling incentives over time, you get more attention to recovery rates, and maybe you eventually get new projects. But the lead times are long and the refining chain has its own bottlenecks. In other words, silver's supply elasticity is limited right when the demand story is structurally expanding. That's how you get deficits that persist. That's how you get a market where the curve starts talking. And that's where the real pressure starts. Now let's bring this back to market structure, because that's where the why now becomes undeniable. In a quiet market, you can have deficits and still have sleepy prices because inventories and financing smooth everything out. In a stressed market, the derivatives layer turns those slow fundamentals into fast moves. Here's the simple version of the reflexivity mechanism. When silver runs into big strike concentrations, think round numbers like $90 and $100, options positioning matters. If there's a lot of call open interest and price approaches those strikes, dealers who are short those calls often hedge by buying futures as the delta increases. That buying can push price higher, which increases delta, which forces more buying. That's a gamma-driven feedback loop. It doesn't require a villain, it's just hedging math. And in a high volatility environment, that hedging can be jumpy. It can also reverse violently on pullbacks, creating air pockets. That's why you can see days where silver looks like it's teleporting. And that's why you should never confuse the move is violent with the move is fake. Violent is the normal operating mode when gamma is involved and margins are rising. Speaking of margins, this is the part most viewers underestimate until it bites them. When CME raises initial margins, especially when they shift to a percentage of notional style, your cost of carrying a futures position rises automatically as price rises. In plain English, the higher silver goes, the more cash you need to keep the same exposure. That's a built-in leverage reducer. For weak hands, it forces liquidation. For strong hands, it forces cash management. For shorts, it can be brutal because shorts have theoretically unlimited risk and they're paying margin as their losses expand. So margin hikes can trigger sharp corrections even in a bullish regime. And that's your first volatility truth. Price can whip around violently even if the thesis is correct. The trend signal is not the same as the noise. The trend signal is the regime. Macro stress plus structural deficits, plus the curve tightening, plus institutional flow interest. The noise is the path, margin-driven flushes, stop runs, dealer hedging flips, profit-taking. You need both in your head at the same time. If you can't hold both, silver will turn you into an emotional puppet. And that's exactly how people get manipulated without any conspiracy. The manipulation is psychological. Headlines scream bubble, then a fast drop triggers fear, then a rebound triggers FOMO, and you end up buying highs and selling lows while the structure stays intact. Your job is to stop letting volatility choose your decisions for you. So here's your viewer psychology shield. Decide in advance what kind of participant you are. If you're a trader, you respect levels and timeframes, and you accept that you can be stopped out even when you're right. If you're an investor, you focus on regime signals and you size positions so you can survive the path. Either way, you do not let a single day's candle rewrite your thesis. You also don't let a single day's candle confirm your thesis. Silver's favorite trick is giving you proof right before it punishes you. But that's not the part that matters most. The part that matters most is what comes next. Because right now the market is setting up two very different near-term paths, and both can hurt people who don't respect mechanics. Scenario one is the controlled pullback and retest. That looks like silver cooling from the low 90s, probing back toward the mid to high 80s zone, maybe even testing the prior breakout area, while volatility stays elevated but not unhinged. In this scenario, the thesis is confirmed if dips get bought without the curve collapsing back into complacent contango, without registered deliverable supply suddenly ballooning, and without ETF demand going dead. In other words, you want to see digestion, not decay. You want to see the market spend time, not give up the entire move in a panic. Scenario 2 is continuation, squeeze, and gap risk. That looks like silver holding above the upper 80s and then pushing back through $90 quickly, with price threatening $100, not because everyone believes, but because the market is forcing hedges and forcing covers while liquidity is thin. In that scenario, the risk isn't missing the move. The risk is getting chopped to pieces by intraday swings and then getting caught in a gap where you can't execute at your preferred price. That's why you don't romanticize the squeeze scenario. It makes great screenshots in terrible decision-making environments. You trade it with humility or you watch it with patience. Either way, you don't pretend it's a straight line. And that's where the real pressure starts. Now let's get concrete, because finance-minded viewers don't want poetry. They want what to watch. Here's the checklist I'd keep over the next 1 to 2 weeks if the title of this video is true and silver is genuinely leading. First, watch the big psychological zones, not as magic numbers, but as behavioral tripwires. $90 is the first, $100 is the next. Around these zones, options positioning and headline behavior intensify. If price reclaims $90 cleanly after a pullback, that's a signal that the market is comfortable paying up for immediacy again. If price flirts with $100, expect exchange risk controls to get even louder and expect volatility to attempt to shake you out. Watch volatility itself. Elevated implied volatility is not just fear. It's a tax that changes hedging behavior. Second, watch volatility itself. Elevated implied volatility is not just fear. It's a tax that changes hedging behavior and reduces the market's ability to absorb flows smoothly. If implied volatility remains high or rises as price rises, that can amplify upside in bursts and downside in cliffs. Third, watch deliverability signals, not just total inventory headlines. The registered versus eligible relationship matters because it tells you how much metal is actually lined up for delivery without someone choosing to make it available. If registered stocks remain tight while price remains elevated, that supports the front-end stress narrative. If registered starts climbing sharply, that could be a release valve that cools the urgency. Still bullish, long-term maybe, but different near-term torque. Fourth, watch evidence of physical friction that spills into mainstream reporting. Mint delays, retail premiums, procurement chatter. Not because retail is the driver, but because retail is often the visible symptom of broader demand intensity. Fifth, watch institutional flow proxies, like the behavior of major silver-backed ETFs. You don't need a perfect number every day. You need the direction of the regime. Are holdings trending higher? Is interest broadening? Are dips being used to add exposure? Sixth, watch macro triggers that can flip the whole risk mood. Geopolitical headlines, sudden shifts in central bank credibility narratives, or data that changes rate expectations. Silver is high beta. It can get hit in a sudden risk-off in everything episode, even if, paradoxically, the longer-run macro case for hard assets remains strong. That's why you keep your invalidation logic separate from your emotion. Speaking of invalidation, let's be ruthless about what could break this. 1. A sharp sustained easing in geopolitical stress combined with a stabilization in policy credibility could take the urgency out of the safe haven bid, at least temporarily. 2. A liquidity event where leveraged players are forced to sell across assets can smash silver faster than your brain can process, because high beta assets get sold to raise cash, period. 3. A demand shock, where industrial buyers actually step back meaningfully because prices are too high, can cool the physical tension. That is harder in the very short run because procurement pipelines don't T-pivot on a dime, but it's not impossible over time. 4. An exchange-driven tightening cycle, more margin hikes into higher prices, can trigger a cascade of deleveraging that looks like the bull case is dead, even when it's just leverage being reset. 5. A curve normalization, if backwardation or front-end tightness evaporates and the market goes back to a comfortable carry structure, can reduce the squeeze potential and shift the market into a slower grind. None of those are guaranteed, but you need them on the dashboard. Because the point isn't to be permanently bullish, the point is to be mechanically accurate. And that's not the part that matters most. The part that matters most is how you protect yourself from the one thing silver does better than almost any asset. It weaponizes your timeline against you. If you're watching minute by minute and your position sizing isn't built for chaos, silver will make you do something dumb. It will make you chase. It will make you panic. It will make you swear you'll never touch it again right before it rebounds. So here's the discipline shortcut. Treat the trend as a higher time frame thesis and treat the volatility as a lower time frame tax. Your goal is not to eliminate the tax. That's impossible. Your goal is to not let the tax bankrupt your conviction or your account. That means you plan entries. You respect risk. You accept that missing a move is cheaper than being trapped in one. It means you stop thinking in absolutes or its crash, and you start thinking in scenarios, retest or continuation, controlled or chaotic. Because if this one level breaks, the math changes, and you want to be ready, not reactive. So why is silver suddenly leading the metals market right now? Because the macro bid lit the fuse, structural deficits kept the fuel flowing, industrial procurement refuses to blink, and market structure, margins, options, reflexivity, and deliverable inventory categories turned that slow story into a fast one. The mainstream missed the hidden detail because they stared at the price and ignored the plumbing. And the plumbing is where the real trades get forced. Now, if you're watching this like a mechanics first investor, someone who cares more about incentives than narratives, this is your edge. Don't argue with the candle. Interrogate what the candle is forcing other players to do. Are shorts being pushed to cover? Are dealers being pushed to hedge? Are leveraged longs being pushed to liquidate into margin hikes? Are physical buyers being pushed to secure supply ahead of delivery windows? Those are the real levers. And here's the final thing I want to leave you with, because it's the one metric that quietly tells you whether silver is still the leader or just the loudest. Watch the price of time. Watch how the near months behave versus the later months. Watch whether the market keeps paying up for immediacy. Because when silver leads, it's not just because people want silver. It's because the market can't comfortably finance and deliver silver at the pace the world is suddenly demanding it. If you see that pressure persist, you don't need to guess a perfect top. You just need to respect that the path will be violent and the regime can still be bullish. And if you see that pressure relax, you don't need to panic. You just need to adjust your expectations. Less squeeze, more grind, more patience. If you want to be part of a crowd that doesn't get played by volatility, people who watch spreads, inventories, margins, and incentives instead of chasing feelings, stick around. Drop in your own what I'm watching next week checklist in the comments, because the smartest communities don't share predictions, they share dashboards.